Let's talk about how I use the tax code and my knowledge of it to save my client $26,000. Hey taxpayers, Tiffany Gonzalez CPA here, founder and CEO of Accounting to Scale, and I'm here to tell you a great story, one of my favorite stories, about how having an accountant that listens to all of the details and asks all of the right questions is so important. My client, unfortunately, became a widow about 3 years ago. When her husband passed, in that year, we used married filing jointly status, which you're allowed to use. We then used, for the next 2 years, the surviving spouse status, which you're also allowed to use when you're a widow. But in the next tax year, you're now required to file as single, assuming you haven't remarried or you don't have a dependent where you could be a head of household, which was the case for my client. She was now a single taxpayer on her tax return. Now, in the year that she was going to be a single person on her tax return, she sold her home. It was a home that she had lived in with her husband for 17 years, and they purchased it 17 years ago for $440,000 together, 50-50. Now, when my client went to sell this home, it was valued at $912,000. That's amazing. 17 years later. She was so happy about the sales price, but very anxious about the potential tax implication that she would experience when you have a sale price of $912 and a purchase price of $440. So in comes the personal home exclusion, right? This is an exclusion you can use when you own the home personally and live in it for at least 2 of the last 5 years, which my client did. In fact, she lived in it with her spouse. Now, normally, a married filing jointly couple receives an exemption of $500,000, but a single person only receives an exemption of $250,000. What is interesting about this rule is if you sell your home during the years in which you are married filing jointly, in the year in which your spouse died, or a surviving spouse, you can still receive the $500,000 exclusion. But you see, this was the year that my client was now being considered single. So what was only available to us at this point was the $250,000 exclusion. But you see, this is where I really got to thinking. I didn't give up because I'm not in a rush to complete anyone's tax return. I'm in a rush to help my taxpayer make sure that they only pay what they absolutely need to pay. So as I thought about this a bit more, I thought about step-up basis. What is step-up basis? Well, we've made this amazing video on YouTube. I'll link it right here if you're on YouTube. But if you're not, just a quick tidbit. Step-up basis essentially means that when someone passes away, the value of the inheritance is stepped up to the fair market value at the time of death. So what did we do? We had to look back and see what was the value of the property on the date in which her spouse passed. We sought the advice of a trusted real estate expert for comps, these are comparable home sales, to get an idea of what her home would have sold had she sold it at the time of his death. In doing this, we were able to see what the value of the home would be, take 50% of that, and be able to justify that she had a stepped up basis in 50% of that home purchase. This allowed my client to deduct an additional $130,000 of cost basis, which saved her $26,000 in capital gains tax. My client was happy, and so was I. This strategy can be a game changer, and so many others, and it highlights the importance of having a knowledgeable and savvy CPA who's on your side. Hit the like button, subscribe to my YouTube channel, and let's start working together. Follow us on LinkedIn, Instagram, and Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.